Hi, everyone. Let's explore three different topics this quarter. First, let's look at leading indicators, which may help show us where our portfolios are headed. We'll look back at performance year to date, and then we'll take a look at how elections can have an impact on our investments as well. So first, we're going to start with price to earnings ratio, or PE, which simply means how many times the earnings are stocks trading at. Historical average is about 16 times earnings is a fair price on the stock market, as indicated by the middle line on the screen here. We're slightly below that today, right around 15. So some may argue that the market is fairly priced or perhaps even a little undervalued at the moment. And what does that mean going forward? Well, on the left side, this is a 12-month scatter plot of the performance based on different PE ratios. And so if we are right at the average right around 15 and the average performance going forward, we can expect returns right around 10% or so for the next 12 months. Now, 12 months, there's a lot of variability in there, and you can see those scatter plots are all over the chart. So the graph on the right side, or the chart on the right side, is a 5-year PE ratio. And again, based on where we're at today, right around 15, we can expect that 10% return over the next 5 years. Now, analysts have released some corporate estimates, and corporate profits are looking very positive going forward, as indicated by the blue bars on the left chart there. And so even with those higher corporate earnings, and you see that on the right side in the black, what's really been driving the performance lately has been a decrease in the share price. And so that's indicated by the blue and the green on the bottom of the chart there. Stocks have been negative across the board. For the third quarter, it's been no different. So small, large, and everything in between in the US has been primarily negative, with the exception of small cap growth during the third quarter. The US market makes up about 61% of the global stock market. So developed international stocks, it's been a very similar story there, negative across the board. And the same is true for emerging markets, so countries like Brazil and India. Country by country, most markets have been negative, with the exception of a few on the very left side of the graph there. The blue is the global stock market in the middle, and the US outperformed the global market just slightly, but we've been negative this quarter. Fixed income is a very interesting part of the market these days. The Federal Reserve has been raising interest rates. And what that does is it pushes up the yields, or the interest rates, on the short end of the yield curve. And what that means is if you want to lend your money, so you buy a bond and your dollars are being lent to, in this case, the US Treasury, the US Treasury will pay you more interest for that short-term loan than they would if you lend your money to them in the form of a long-term loan or a long-term bond. And that's completely backwards. Normal yield curve, it has a positive slope to it. Right now, we have a little bit of a negative slope to the yield curve. However, for those of us that do have bonds in our portfolio, with the increasing interest rates, that should help with interest income going forward. You can see the interest rates have come up for both government and corporate bonds on the right side of the screen. Now, the other thing that an inverted yield curve can show or indicate is the start of a recession. And so coming out of a recession, we can see some very strong double-digit returns. In fact, small caps tend to lead the way historically, but across all different asset classes, you see the average returns in the far right side of the screen here. Across all different asset classes, we can see some strong double-digit returns depending on the asset class. Now, with elections around the corner, you may be asking, well, which party is better for my investments? And the reality is the stock market doesn't care. It's done well, whether it's been Democrats or Republicans in control. If we look at a little bit more closely at midterm elections, especially the graph on the right side here, if the party in control loses control at the midterm, the forward-looking returns are much lower than if that party maintains control at the midterms. And so with that, I hope this has been helpful for you. If you do have any questions or concerns about your own finances, please reach out or go to wismedfinancial.org and schedule an appointment using the button in the top right corner of the website. I wish you well. Take care. Bye-bye.